with one single family property, multifamily properties. We work with syndicators. We have a fund, and we do accounting, tax strategy. So we do tax planning for people, as well as just like a number of other CPA related services. My background, I started off at an accounting firm called BDO. It was a large accounting firm. I did general audit. So I just audited companies and realized, hey, look, this isn't really what I want to do. I'm not really, I don't want to sit around an audit table all day. And I looked at guys 10 years ahead of me and said, that's not me. So I left, and I started to pursue real estate, invested with John in a number of deals as a limited partner. And then ultimately participated in a deal as a general partner with John, Chris, and a few other people at the time. And then I came across the Real Estate CPA on LinkedIn one day. I messaged the founder. And I said, hey, look, I love real estate. That's my passion, real estate investing. I'm background as a CPA. And he said, hey, look, man, I'll give you a shot. And from there, started working with him. I've been there for around 2 years or so now. And I just work with people to help them reduce their tax liability as far down as possible. So that's just a little bit about me. But we want to get an idea of just everybody here. Where are you? Just a show of hands. Are you single family investors? Any single family investors here? 1 to 10 units or 1 to 2. We have any syndicators here outside of maybe John and Chris, and any limited partnerships? All right. So I think what we could first start out with just kind of an overview of how passive losses affect different investors. I think that's a very important topic to understand, and then we kind of dive in from there. So the first thing to realize about real estate is that it's a tax advantage investment. People always say it's tax advantage because your ordinary income is taxed at a rate of 0 to 37%. So that's W-2 income, that's self-employment income. If you're a consultant, if you own a business, you're pretty much getting taxed at 0 to 37%. And then you have state taxes as well. But with real estate, your rental income is taxed at that same rate. However, there's something called depreciation. It's a non-cash expense, and this depreciation expense can be manipulated, if for lack of a better word, to be increased to completely eliminate, basically bring your gross income from real estate down below 0. And that means you're not paying tax. So it means you could, let's just say, for instance, you have $10,000 in cash flow that you have, but you have a depreciation expense of $11,000. So you have a $1,000 loss, and that means you didn't pay any tax on that income while you owned it. So you could be in a high tax bracket. You could be at the 35, 37% tax bracket and have hundreds of $1,000s in rental income and not pay any tax on it. So that's what people often say when they say real estate's tax advantage. Basically, you can invest in it. It's the best investment you could probably make outside of your retirement account because you could shield all that income from tax. The question most people have is what happens to the losses? So you have these depreciation expenses and they create a loss. And that loss, if you're a passive investor or if you're not a real estate professional, we'll talk about that in a little bit, those losses get suspended and carried forward into future years when you either have passive income, so rental income in this case from other activities, or you sell a property at a gain. Those losses are then unlocked to help mitigate that gain from sale. Now, anybody here full-time in real estate, or is it all, so you're full-time just recently? Okay, so congratulations, big step. And so if you're a real estate professional, there's something called the real estate professional status, and you achieve the status by working in the real estate field in a real estate trader business for 750 hours, at least 750 hours, and more than half of your total working hours. So if you work a full-time jobs are generally 2,080 hours. It's going to be pretty tough to duplicate that. Into being able to get this status. But if you can achieve this status as a real estate professional, you can take those losses we discussed, instead of having them carried forward and only be used against your other rental income or other passive income in the future. Instead, that can offset your ordinary income, right? So this is the most lucrative status you can achieve as a real estate investor. Many investors want to get to this point. And then basically what you can do from there is you can use something called a cost segregation study to increase your depreciation expenses on your property. So cost segregation study You're going to have an engineer generally go down to your property. They're going to walk it. They're going to break down the components of your building into different class lives, 5, 7, 15, and 27.5 year class life. If you're investing in residential. If you're investing in commercial real estate, that's 39 years. So typically, without a cost segregation study, you're taking the cost of the building and depreciating it over 27.5 years. So every year, you're going to have a little expense that's going to basically help you reduce your taxable income from the rental real estate. With the cost segregation study, they break it down anywhere from 20 to 30% of the property. You have a question?
Yeah. At what point does it become cost effective? Because I know also hiring somebody costs thousands of dollars as well. At what point or how many units?
Yeah. Great question. So there's something called a software cost segregation study, where instead of having an actual engineer come down to your property, they usually fly them out. Instead of having that happen, they use a software that if you have a property under $500,000 and under 5 units, you're going to get roughly the same results of a traditional study, but for about $399. So at that point, it's worth considering doing the software study. Usually on properties as low as $150,000, you're going to get some net benefit from that. So with the cost segregation studies, again, just to kind of go through that part so everybody understands how it works, is you're going to, the engineer, or in this case, maybe the software, is going to break down the components of the building to 5, 7, and 15-year class lives. So instead of depreciating the building over 27.5 years, you're going to depreciate the building over a part of the building over a shorter time period, which increases your depreciation expense. Now, there's something called 100% bonus depreciation that came out with the Tax Cuts and Jobs Act. Basically states that property with a class life less than 20 years can be 100% depreciated in the first year of ownership. So if you think, so let's say, for instance, let's use an example. It's probably the best way. Say you buy a property for $100,000. You get a cost. You run a software cost segregation study in this case, and 25% of that building's value, $25,000, is 5, 7, and 15-year property. Instead of having those components depreciate over 5, 7, and 15 years, so it's going to spread out, you can take that entire amount in depreciation in that first year, in year one. So
what's going to happen with as far as the tax consequences when you sell?
Yeah, so when you sell that building, part of the depreciation that you took is going to be recaptured. It's going to be recaptured at a maximum rate of 25%. So it's about 10% higher than your average capital gains rate. If you're at the 20% rate for capital gains, I think it's like $465 if you're married. You're going to be there. So basically, you're going to recapture it, but you got to look at the time value of money, right? If I'm going to hold a building, let's just say you hold a building for 10 years, and you're at, let's say you're at the 37% tax bracket, and you do a cost segregation study on $100,000 building, and you have that $25,000. The 37% tax bracket, you're going to be looking at a $9,250 savings. Chances are you might be purchasing a property much more than $100,000. So if you could take that money and reinvest it today, you can reinvest it today, say an 8% return, which is pretty conservative for real estate. You're going to have a much higher rate of return on that money than if you would have just left in the deal and depreciated it. Not to mention, when you finally do get to the point where you can sell that building, there are ways to mitigate that depreciation recapture tax. And we can get into that. Anybody interested in hearing some of those strategies? Or okay, so we'll go through the strategies one by one. So the first one is 1031 exchanges. 1031 exchanges. It's very simple. You have to roll virtually the entire sales proceeds, high level, into your next deal, and you defer the capital gains, including the depreciation recapture, so that portion, indefinitely until you sell that building. And if you sell that building, you can do another 1031 exchange. And you can continue doing 1031 exchanges throughout your lifetime, and this is easier said than done, until you pass away. When you pass away, you leave it to your heirs, and they receive the building at what's called a stepped-up basis, which is the fair market value at the date of your death, which eliminates all of the capital gains you should have paid had you sold it in your lifetime. But the next, it's not like I said, it's not that easy. But we've seen it done. The next one is by using a cost segregation study on a new property. So let's say that you're selling that property and you have that capital gain, including the depreciation recapture. You go buy another property, do a cost segregation study on that property, use bonus depreciation to increase those passive losses, right? Those passive losses can offset that passive capital gain from your property, including the depreciation recapture. So that's another way to, again, I guess, kick that tax down the line is the best way to put it.
Another quick question. If you're house hacking,
Yeah.
let's say, how does that affect, because I know in a primary residence, so I'm house hacking in a two-family, can I still take depreciation?
Yes. So you're gonna split the building between business and personal use. So let's just say the house is $200,000. Let's just say, and you have a duplex, roughly the same, square footages and everything. You're gonna split the property in two, and then you're gonna depreciate $100,000 of that. Yeah, and that's how that would work. You're gonna deduct pretty much half of the expenses related to the entire property. So the mortgage interest gets split in two between personal and business, and property taxes and all expenses related to that building would be split in two.
And then when you sell it, how does that work?
So
1031 exchange my primary, right?
yeah, I mean, you can. It's complicated. There's complicated, takes some planning, and you might end up having to move out of part of the building. Some people, okay, so there's a strategy where you can do, there's something we could do this. So there's something called the Section 121 exclusion that allows you to, basically, if you're single, $250,000 worth of capital gains on the sale of your primary residence can be excluded from tax. If you're married, that's $500,000. So what you'd probably do is you 1031 part of the building, and then you would use Section 121 on the other half, the personal half. So you wouldn't pay tax on the personal half, but you would pay. You would then defer the other part. And we've seen that done before. Again, this stuff gets a little bit more complicated when you're playing. Yeah, lawyers going to use a qualified intermediary, which is basically a 1031 exchange expert, and they provide services to kind of hold money escrow. There's some stuff in there, but it's.
When you do the exclusion, are you deferring it like a 1031, or it just disappears and it's money in your pocket?
Oh yeah, great. So with the exclusion, it's completely. It just it's on the primary residence. So that's the one thing. When you sell your primary residence, there's a good chance you may not pay property taxes on it, depending on ultimately, where you live. I mean, we see people in California, or potentially even in New York, where they have such large capital gains on their primary residence, they still have to pay tax, but it can exclude a large part of your primary residence, or most of it. Yeah. The one thing I always say to people is if you have taxes to pay, first of all, you have a good problem, because that means you're making money. If you're not making any money, you don't have any taxes to pay. So that's a good thing. So it's kind of the passive losses and how you can kind of go around doing it. The next strategy you could do is you can also offset capital gains with capital losses. So sometimes you might have some sale of other capital assets. You might have a building that you bought that is not going to it's not going to recover. You bought it wrong, you bought it bad. Maybe some stocks that some stock investments that you invested in that aren't going your way. You don't think it's going to recover. You could sell those, and you could take those capital losses and offset the capital gains from sale.
Are they limited to X amount?
So capital gains, you could no. So capital gains losses, no. It's all you could take the maximum of $3,000 of losses against your ordinary income when you have capital gains, but capital losses rather. But with capital losses, you can take them against your capital gains without limits. So that's another way to do it. It's called tax loss harvesting. The only downside to that is you actually have to have legitimate losses that you're willing to say, I own this stock, I own this building, and it's not going to recover. So I'm going to sell it and then take the losses against the active income. So.
Does that change if you have the status of a real estate professional?
Yeah, so if you're a real estate professional, chances are you're not going to have much passive losses, because your passive losses get turned to active losses when you're a real estate professional. So you're going to take those losses generally off of your ordinary income if you have ordinary income. If you don't have ordinary income, then it's going to get ultimately carried forward. But
So you still can carry the loss forward if you didn't, let's say I made zero commissions or investments and it's only no W-2s, then
it's gonna carry forward. But for the most part, the reason why people have passive losses to begin with is because they have ordinary income, and they just can't use it because they're not real estate professionals, so the loss get carried over. And then when you are a real estate professional, usually you're in a position where you're making the type of money to have those losses actually be utilized, and it's usually part of an overall tax plan. But does that answer your question there?
Yeah.
Okay.
Being a real estate professional, does it increases your chances for audits?
It depends. It depends on what else you have going on. If you're working full time and you're trying to get the real estate professional status, or you just have high income, high ordinary income, it's definitely going to increase. It's going to increase. Someone might take a second look at your return, but. Yeah, no, I mean it is more riskier from an audit perspective to qualify for that status to begin with. But the one thing people realize when it comes to the game of tax, right, is that you have to be willing to, as long as it's a legal position, you could do it, and you just have to be comfortable with taking that risk. That if I do get audited, can I substantiate my position? And if you feel comfortable, and your attorneys, your professionals that you're working with feel comfortable substantiating a position like that, then you should have no fear of really going into it, just realizing, hey, look. Now that said, if your position, if it's a small number risk, a small number, and you're going to do a high risk strategy to mitigate a small number, it might not be worth it. But if you're going to do, if you stand to gain a substantial amount from doing the strategy, it probably makes sense to do.
Can you talk a little bit about, because I think we've covered some strategies, we can do that as well. Talk about somebody that maybe, I know we spoke about this before, but doing taxes on their own, doing TurboTax or with a CPA, maybe not happy. What are some of the steps somebody should take? What are some of the things they should look for that maybe could be doing better? What's the process of doing better on their tax returns or trying to do better? How does that process work for somebody that's not happy with what's happened so far, or maybe wants to find out if they should be unhappy?
Yeah, you definitely want to get your tax returns reviewed by a CPA. Maybe you get a second opinion. In some cases, if you believe your CPA hasn't been doing what you thought they were going to be doing. If you're doing them yourself, you can have a CPA review them after the fact you do it. I know if you're using TurboTax, there's a number of services TurboTax provides that can help you review it. But I guess the steps are, if you believe you're unhappy with it, take it to a CPA that you believe is qualified to review it and is going to help your position, because they're going to be able to point out things that you could perhaps do better next year, or you can sometimes even go backwards and amend your return to fix errors from the past. But that's the steps. I mean, if you feel like you're unhappy with your tax return, take it for a second review by somebody else. I mean, ultimately at the end of the day.
If somebody was looking to hire a CPA
Mm-hmm.
and for some ungodly reason they decide not to use you, don't know why they wouldn't, but if they're going to somebody else, or maybe they should ask you these questions, what are the questions somebody should be asking of the CPA they're going to use to find out, is this person a good fit for me? Do they understand the things I'm in? If I'm in real estate, do they understand real estate well enough? If I'm in manufacturing, do they understand? We're real estate based, but what are some of the questions they should be looking for? What are red flags? What are really good questions that people need to be asking to make sure they're getting the best service possible?
Yes, I mean, I think the first question you want to ask is, how many clients do you have like me? How many clients do you have in the real estate field, say, in this instance? How many clients do you have that, let's just say, you have 4 units, right? 4 single-family units. How many investors do you work with that have 4 single-family properties? How deep is your real estate expertise? What is your, as a CPA firm, you could specialize in all these different aspects of business, manufacturing, real estate, e-commerce, you name an industry, you could specialize in it. What industries do you specialize in? Who will I be working with? Who's on your team? Are they CPAs? Do they invest in real estate? Are they experienced in real estate as well? Do they understand investing? Because, as a real estate investor specifically, there's all different types of investment strategies. And yeah.
So if my CPA says, why are you opening up another LLC, I should leave?
No. That's a good question. That's a good question to ask. We live in New York. There's no franchise taxes here in New York, so you could open up as many LLCs as you want. And really, when it comes to LLCs and entity structuring, just to go down that path real quick, it really, for the most part, that's for liability protection. It's not really for tax purposes generally. I mean, they're...
That's still a qualified question like that. It's an okay question for my CPA to ask me. Why are you handing me another LLC paperwork?
Yeah. Because your CPA might have good, another entity structure that might be more. Because what it is, when it comes to LLCs, it becomes an administrative burden. You might have to file another tax return depending on if you have a partnership, and then you have to just manage the paperwork. I mean, to keep things clean and organized, most CPAs are going to try to consolidate down your entity structure, but your attorney may not like that. So, I mean, it depends. If your CPA asks you that, I wouldn't say that's a disqualifying question.
He could be trying to save you money as well, right?
Yeah, I mean, he could be trying to save you money. You know what we see? We see a lot of couples, right? They'll start opening up partnership LLCs. Most people don't know you don't just file a partnership tax return on your 1040. You have to file an actual partnership tax return for each LLC that you open up that's one or more member. And those can cost, $1,000, $1,500 depending on, who you're working with, what you're doing. So, I guess the bottom line is there. Yeah, they might be trying to save you money. Why are you opening up another partnership LLC, when you could be using the same one you're using now, or you could be using a single member LLC and reporting it directly on your 1040 instead of having to pay another fee each year that you have the LLC.
So it's different goals. Basically, my lawyer's saying one thing and my CPA saying another.
Yeah, I mean, I mean, see, lawyers and CPAs are sometimes at odds because the lawyer's looking at everything from an asset protection standpoint. They're looking at all the what ifs of what could happen to you, but a CPA is looking out to reduce taxes. I mean, that's really what a CPA is looking at. And also, attorneys, to be fair, sometimes they use a lot of fear to say, oh, well, what if the moon, crashes into your living room? You need to have this LLC in place, whatever. Whereas a CPA might sit there more objectively and just say, look, this person had, like, for instance, one of my clients is works, a very conservative person, works a W-2 job, doesn't do much to get themselves in trouble, and this guy has him in a Wyoming LLC, like in this like trust and doing all this complex stuff. And I'm like, why do you need to have your brokerage account with your stock in an LLC? Oh, it's for asset protection purposes. I'm like, who's going to sue this guy? I mean, this guy's not doing active real estate. He was investing in passive investments. So as a limited partner, you're already protected from a liability perspective. So why does this guy need that? And now he lives in California, and California is an $800 franchise tax per LLC you have open. So, that's just an example of something that's maybe at odds. Yep.
Our CPA recommended that we do S corps for our real estates instead of LLCs.
What do you?
Invest with my wife,
Mm-hmm.
and all our units are in S corps instead of LLCs. Can you think of what was the reason to come up with a structure that is based on S corps?
So the reason why people use S corps is because there's something called the self-employment tax. Self-employment taxes, and I'll answer this. We'll answer it through this, right? So it's whenever you do something that makes you consider self-employed, maybe you're a consultant, you're a doctor, you're a real estate agent, you get taxed an additional 15.3%. And S corps allow you to pay yourself a wage. That wage is subject to the self-employment tax of 15.3% and shareholder distributions. Shareholder distributions are the rest of your money not considered wages and are not subject to the self-employment tax. So that's why we use S corps. Now, I don't know exactly why attorneys tell people to put their real estate in S corps. That causes a number of problems, primarily for estate planning. If you have your property in S corporation, the only way to get it out is through a sale. So if you ever want to transfer that asset into another partnership, say like a family limited partnership or something like that, to pass it down ultimately to your heirs, you have to sell the property out of the S corporation. So that's the only way to get it out. With a partnership, you could transfer it out. With a single member LLC, you could transfer it out relatively easy without creating a taxable event. But with the S corporation, it's the only way to get out. So I don't know why people do that. It's a good question. I should probably ask some attorneys why they do that. But we always recommend it, and other CPAs that we've talked to also recommend not putting your properties in S corporation. You either want to have them in a single member LLC, which is a disregarded entity, meaning it's reported directly on your tax return, and also or a partnership. A partnership, like I said, is a partnership between you and your wife would have a partnership. You still need to file a tax return, but it's easier to get that asset out of the partnership should you need to get it out for whatever reason. So to answer your question, I don't know why your attorney said that. I'm going to have to look into that, though. It's a good question.
I always, the corporation, I thought, had different write-offs than LLCs, but different write-off rules, I guess.
Yeah, I mean, there's some, but the problem is with rental real estate, if you're just doing a purely rental real estate business, you're only having passive.
More active,
Yeah.
active, not passive.
Yeah, no, if you're active, if you're like an agent or something, that's when it makes sense. Flips too. But if you're just buying and holding, flips. That's maybe were you telling me you were going to do flips?
No, we mostly hold.
Yeah, I don't know. I don't know because Yeah, if you're flipping properties, you could get subject to ordinary income, and that could be mitigated. And the self-employment tax, the S corp can mitigate that. But yeah, I don't know why people would put that for buy and hold. It's usually not the best entity structure for that. Good question right over here.
You can own an LLC and still file as an S corp.
Yes, you can have an LLC. You can elect to have it taxed as an S corporation. So what we often tell people is even when I think about it, if you have an S corporation, you have to file an S corporation tax return, which can cost anywhere from again like $1,000 to $1,500, perhaps more. And what you can do is you can create a single member LLC, and you can earn your income. Say you're an agent, and you're not making much income yet as an agent. There's no need for you to file that extra tax return. But you can then elect later on when you're making more money to elect to have that as an S corporation if you want. So there's flexibility with the LLCs, but starting out as an S corporation, if you're just doing passive, buy and hold investments, not the best strategy, not the best entity structure.
So you can have an S corp and then have an LLC report to the S corp.
So. Yeah, you could. So S corporations, you can either open up an S corporation, which is just a derivative of a C corporation, just taxed in a different way, or you can have an LLC that's taxed as an S corporation. But to answer your question, I think what you're saying is you can have an S corporation, and you could have that S corporation own an LLC underneath it. Like if say your S corporation is I Buy Houses LLC, right? You can have an entity underneath that S corporation called, Texas Flips or whatever, and that's all. That's the entity where you flip all your Texas properties out of the single member LLC owned by the S corporation, and it'll all flow up to the S corporation. Does that answer your question?
Yeah. So how tax wise at the end they tax it differently?
Yeah. So this.
You say if you're holding a rental in that LLC, but the LLC report to the S corp.
Yeah. So the.
They're like owned by the S corp behind. So how would that work?
Yeah. So if you own, whatever entities are owned by the S corporation are gonna roll up to the S corporation. The S corp. So S corporations and partnerships, they don't pay tax at the partnership or the S corporation level. They file a tax return. That tax return is filed with the IRS, and then you receive, as the investor, or the owner of the entity, you receive a K-1. That K-1 is reported onto your individual tax return. So that's how it's reported. So to answer your question, just to sum this up, if you had an S corporation that owned a single member LLC, the single member LLC, whatever activities in that single member LLC is going to get reported up to the S corporation. The S corporation is then going to give you a K-1, and you're going to report the K-1 on your tax return.
Are you asking about two separate entities, or are you asking only about one?
Look like it's report you can have file for like a LLC for an S corp.
So what he was saying is,
if somebody who was structured have an S corp and then have all the LLC report to it.
okay.
But those LLC are like holding rental instead of flipping.
Yeah,
How would you sell it? Can you sell it, or or can you transfer or sell it like you said before?
So yeah, that's a good question. That's a good question. I'm gonna be honest. I don't know off the top of my head. I have to take a deeper look into that. I would say that if you're gonna sell, because the S corporation owns the entity below it completely, I would have to say, if I had to take a guess, it would have to be it'd probably be the S corporation is going to follow the S corporation rules, because the S corporation is the owner. But I'd have to take a second look at that if that were to be a case. I haven't come across that yet.
is there any benefit to having LLCs owned by an S corp, or not really?
It maybe if you have different businesses, like, so say because you use that S corporation to mitigate that self-employment tax we talked about before. Maybe you have multiple businesses that use that are subject to self-employment tax. Maybe you have a flipping business. Maybe you have an agency or brokerage. So you might have those two entities with both have self-employment income. So you have just two LLCs beneath that S corporation that report up to that S corporation. So you're mitigating the tax from both through one entity, rather than having two S corporations, one for each business, and then you're going to have to file two S corporation tax returns. So that's one reason why I would maybe see that happening. Any other questions people have today, or I could just go through some of the stuff? Yeah.
Just to get back to the cost segregation for a second. So you're basically on bonus depreciation, reducing your cost basis.
Yeah.
Right? During the like during that hold period, if you're doing capital improvements, how can you get that? I guess how can you increase your cost basis, and is that something that you give to your CPA? So if you're going to repave a parking lot, if you've taken that full depreciation, say year one,
Yeah.
how do you go about doing that?
Yeah. So what happens when you make capital improvements, it increases your cost basis. So if you were to put a new parking lot in, that's going to be parking lots, I believe, are land improvements. Land improvements are a 15-year property. So you would have a new 15-year property on your depreciation schedule.
And then does that go back to whatever it was in terms of like a 15, 10-year?
So yeah, that would be 15-year property. It would depreciate over 15 years if you don't use bonus depreciation on that single improvement.
But if you did, so say you took that bonus depreciation.
You can use bonus depreciation on it.
So
on that.
If this year I spend $15,000 on redoing the parking lot, I can deduct that.
Yeah, you might have to do a partial disposition from the original parking lot, but that's something we'd have to take a look at.
Is that your CPA who does that, or do you go back to the cost segregation?
Oh yeah, no. Your CPA would handle that. Yeah.
But don't you have to recoup that once you sell the property?
Yeah. So what happens is whenever you take depreciation, you have to take depreciation. There's no way around it. It's going to be recaptured when you sell the building, assuming you sell the building at a gain and not at a loss. Now, the reason why you would do that is the time value of money, right? So, like I said before, if you were to get a large enough tax savings from using the bonus depreciation, you would be better off investing that money at, say, like an 8% return, even conservative. That's a conservative number for real estate, than having that money just kind of, you'd be better off having that money today and then worrying about the capital gains tax later on down the line. And you could, actually then, use one of the strategies but talked about before to mitigate that tax when that time comes. I mean,
I get that. It's just I guess my question is more during the project. So I mean, if you're going to increase your cost basis by $15,000, then you just take that $15,000 right off again. So I mean, really, you're net zero. You're just getting.
You're getting a deduction right away. I mean,
so if you own it for more than a year, so in the first year you took the bonus depreciation, now you're in the second year, you do the parking lot.
Yeah.
How does it work with the bonus depreciation again?
Yeah, so you're gonna put the new parking lot on your depreciation schedule, and you could then use the bonus depreciation on that. But you may have to do a partial disposition of the original parking lot, pretty much depends on how the depreciation of that original parking lot. Like, is it completely taken yet? If there's some depreciation left, you might have to do a partial disposition.
Tom, other than the timing difference, you're also getting a lower tax rate in the end, right? Cap gains tax instead of.
Oh yeah. So also, that's a great point. So if you don't use a bonus depreciation, right, and you have rental income because of that, because you don't have enough depreciation to cover that, you might be taxed at, say, 24, 32, 35, 37%, depending on what tax bracket you're in. But later on, you're only getting taxed on the depreciation recapture at a maximum of 25%. So if you're at the 32, you're at the 35 or 37% tax bracket, you're getting at least a 7% spread right at the 32% tax bracket, perhaps up to a 12% spread if you're at the 37% tax bracket by using this study. So you're paying less taxes today. You're paying no taxes today, and you're paying less taxes than you would have paid. You're paying less taxes in the future than you would have paid today had you not used the study. So that's a good one, Nick. Thanks.
Going back to the where you said $150,000 to $500,000 homes, or units, 1 to 4 units. You said about $399 is what we could possibly be charged for the cost segregation study because of the software. Where would we get this, or would we get this, or is the service that uses the software you're talking about?
So you could get a software study, and there's more than one. Vendor of these. One of them is kbkg.com. They do it's $399. There's another one called Titan Echo. I'm more familiar with kbkg. A lot of our clients have used that one. Titan Echo, I can't vouch for, but it's something that I've seen, and they've came to us and tried to pitch us on using their service. But it's just another one that's in existence, something for you to check out.
They'll just take our information, or they'll look up public information, see what's there,
Yeah.
kind of thing.
Yeah. So what happens is they have a questionnaire. They're gonna ask you some questions about the house, the age, the sales price, I mean the purchase price rather, where what the square footage of certain areas are, what type of how many refrigerators you have in it. It's basically a questionnaire where you just answer a bunch of questions about your property, and then they basically use algorithms and national databases of costs pretty much to come up with what that study looks like. How they actually do all of that technical stuff in the background is a little bit beyond what I understand. But that's pretty much how they get it.
They'll spit out this report, you get the report, then hand it to the CPA kind of thing?
Yeah, that's pretty much how it's going to work. Same thing if you did a traditional study. The traditional study is going to generate you a report, or they're going to give you a report rather, and you're going to give that report to your CPA, and they're going to basically they're going to just file that along with your tax returns to make a long story short, and you're going to see the benefit from the study from doing that.
When can you do a cost segregation?
You could do a cost segregation study as soon as you buy the property.
If you already own the property.
You could do a cost segregation study at any time. You could retroactively take it. What would happen is so you have 1 year, you could amend your tax return. So let's say right now you could amend your 2018 tax return and go take the cost segregation, the benefits you should have gotten from, let's just back this up. So let's say you bought a property in January 2018, right? You buy that property and you never heard of a cost segregation study before. No one ever told you about them. You never used one. Now it's July. Let's call it July 2019, and you go and get a cost segregation study performed. You can go back and amend your tax return for 1 year and apply that cost segregation study to your 2018 tax returns. If it's beyond 1 year, so now let's say we're in 2020, and you want to do your cost segregation study on your 2018 property, you can still do the cost segregation study on the 2018 property. But you're going to file a Form 3115, and you're going to basically take the depreciation you should have took from that study in years 1 and 2 in year 2020 on your 2020 tax return. In this example. Now, the one caveat there, one thing to note, is that if you do that after that 1 year, you're not going to be able to take 100% bonus depreciation anymore. 100% bonus depreciation only applies to first-year property. So it's the first year you place that property in service is when you're going to be able to take that 100% bonus depreciation.
Older properties, let's say I've owned something for 5 years, there's no way I'm going to recoup any of that.
Yeah, usually if the property is around, you own the property for around 5 years or so, you may not, the cost segregation study may not be as effective because that 5-year property would have been already depreciated at that point. But it depends. It's a case-on-case basis. Really got to look at every situation. But with the studies, they give you a free estimate. So if you're gonna get one done, you could get the estimate from the cost segregation company, give it to your CPA, let your CPA do the analytics behind the scenes, and say, okay, well, if you do the cost segregation in year 4, this is how much you're gonna save net. And it's basically gonna be using tax planning software to get to that answer.
How does, because the cost segs we do for the larger properties, the full studies that are more expensive are fairly audit proof. How does the software ones compare to the full studies in terms of security and liability and things of that nature?
So the software studies are still very detailed. KBKG also does, for instance, in this case, they also do regular studies, so you could hire them to do. You could hire them to do it. Really, what it's going to come down to is the guarantee of the company. So KBKG, for instance, has an audit guarantee. So if you get audited, they're going to support you through the process, and they're going to make sure that their report is put up in the best light possible. Now, that said, software cost segregation studies definitely carry a little bit more risk than a traditional study. That's why they're only available on properties of less than $500,000 or less, or 5 units, because the risk, there's just a lot less risk when you're playing with those numbers than if you were to do a software study on a $10 million property or something like that, or a $1 million property.
Have they been audit tested?
Yeah, it's a good question. I've never seen one get audited yet. The audit rate for these, according to the cost segregation companies that I've spoken to, is like less than 4%. So less than 4% of all their studies are audited. So. Yeah, but the thing is, when it comes to cost segregation studies, all you have is the IRS ATG to really go off of. There's no real guidance from the IRS, no real authority behind cost segregation studies. So if you're worried about the audit risk, I'd say go with the traditional study. But when you have KBKG, a huge company like that, putting their name behind it, giving you an audit guarantee, it's gonna you're doing it on a property of $500,000 or less, you're gonna be in a good the IRS isn't gonna audit someone for something that small, most likely at this point in time, because it's you got to look at the resources of the IRS. Just look at them right now. They're not good. They're not. If you do a software cost segregation study on a property that's $300,000, is it worth them taking to audit you to hopefully maybe a little bit have a chance to break that? I don't know. Probably. Yeah. I mean, it's not. I mean, they're looking at people who are making substantial amount of money. Substantially.
The software does have a guarantee.
So the software from KBKG has an audit guarantee from them. So, any other questions on stuff, or what topics would you like to hear about on tax? Or
We're still on the red flag questions for the CPA. We only got
Oh,
one
yeah.
question so far.
Okay, yeah. Back to that. So red flag questions. You want to ask them. Yeah. So start off asking them, what experience do you have in the industry that I'm working with? What experience do you have with the clients who are like me? Can you give me a reference? Can you give me a reference to a client who is similar to me that can attest to your services, right? That's going to be a big one. What are your fees? That's the first thing. What are your fees? You want to know fee structures up front. You don't want excuse me. You don't want to kill it like Reddit, what do you call it, blindsided by some crazy fee. So you want to ask them what their fees are. You want to ask them for the references. You want to ask them what their audit history is too. Have you had clients get audited? How have you successfully defended against clients who were audited? You don't want to ask them how long have you been in the industry? What kind of CPE do you use? So one of the biggest things with accountants is continuing professional education, and it's how an accountant basically expands their expertise. And you might want to ask, what CPA have you taken over the last year? And if they said, I took 7 courses in manufacturing, and you're dealing with real estate, you might want to say, well, why, you may want to ask a follow-up question that, well, why aren't you doing CPA in real estate, right? If that's what you're looking at, I'd say those are really the top questions you want to ask. I mean, if you
Way too much.
Yeah, so we've never had a client get audited before. We've been in business for 3 years. So, take that for what it is. When it comes to fees, tax returns for us start at $1,000. That's whether it's an individual or a partnership or an S corporation. It kind of scales from there based on what you're doing. We don't do taxes only. We're an advisory first firm. So we have 2 different advisory lines. We have tax strategy and tax planning, which we pretty much sit down with you and go through a step-by-step. We basically dig into your situation, find out what you're doing, set up a custom plan for you to, follow to minimize your taxes throughout the years. That costs $3,000 for that package. Now on the accounting advisory side, we basically at this point we help people set up their accounts. Make sure that their accounting system is operating. We'll automate it, set up automations for them, and then at that point, after you complete that accounting advisory, we'll either run the accounting for you. We can train a bookkeeper that you hire and you bring on. We could train you on how to run the function. We could train someone who you already have on staff to run the accounting function, and that usually starts anywhere from $5,000 to $6,000, depending on the size of your organization, your business at that point. Really, what it does, for the accounting side, it's really making sure that you have everything set up from the beginning. You're doing everything right. You're not botching your books, because the one thing what happens is with accounting, tax, or anything like that, it's always better to start the right way from the beginning. Than it is to go back and try to clean everything up. Like, I always like to compare it to a shoelace, right? It's a lot easier to tie your shoes the right way the first time than it is to walk around with a bunch of knots in your shoes and try to untangle them. So that's the peace of mind on the accounting side, but that's our fee structure.
Do you have a business card?
I don't have one on me, but I should.
What we'll do, if everybody is on the meetup, we'll send out all of Tom's information tomorrow. We'll shoot an email to everybody soon. You'll have his contact information in your email. If you're not on it, see any of us, and we can get you in contact with him, if not yourself.
Yeah, so
That's probably the easiest way. Shame on Tom for not having a business.
yeah, so we're a virtual CPA firm, right? So a lot of the stuff I do is virtual. I do like speaking engagements online and stuff. So I don't even have business cards for this company. But no, you could find more information about us on the realestatecpa.com. Or you can check out our podcast. We have a podcast as well, the Real Estate CPA podcast, where we talk in depth about a number of strategies. We talk with other investors on what they do, and what they do to ultimately reduce their tax liability.
From your experience, doing the strategy and the planning versus just filing, how much of a difference do you see in tax savings?
Oh, it could be significant. I mean, there's been, for example, the other day, I was just telling Chris and John before, one of our clients, so they had, in 2017, they had around $32,000 in suspended losses on their books. And when they filed their 2018 tax returns, no one ever carried those, whoever their accountant was, never carried over that $32,000, and they sold a building in 2018, and they basically that $32,000 in losses that were supposed to offset that gain went up into thin air. And if they just had the proper planning going in place, people would have caught that and said, hey, look, by the way, it's 2017, you have $32,000 worth of passive losses on your books. In 2018, when you plan to sell this property, or in 2019, whenever you plan to sell this property, keep an eye on this number and make sure that it gets carried over. Also, I mean, with the real estate professional status, for instance, there's been a number of clients who never got a lick of tax advice from anybody, and they qualified as a real estate professional, but weren't qualified, weren't checking the box, and they also weren't using cost segregation studies. I mean, one of our clients just recently. He was a real estate professional for a number of years, owned a large portfolio, never did a cost segregation study before, never took advantage of 100% bonus depreciation. We took his tax liability from, I forgot exactly what it was. It was, it was maybe, I don't know, $30,000 or $40,000, and we wiped it to zero. So, and that's what planning gives you, because we retroactively went back and amended the return, but had he had the proper planning from the onset, he would never had to amend that. He could have just took it from the beginning. So it could be substantial depending on how much tax you pay, what properties you're investing in, what your investment strategy is. It all depends.
In your opinion, to maximize your saving, how often should you be communicating, updating, talking with your CPA, with whether it's you or somebody else?
Yeah, I think it depends on your business, how fast you're growing, how much activity you have. If you're just buying and holding properties, you probably need to talk to your CPA maybe semi-annually or annually. But if you're kind of active in it, you want to at least be doing it on a quarterly basis. If you're really doing transactions at a fast clip, meaning maybe you're a flipper, or maybe you're in grow mode and you're acquiring multiple properties throughout the year, you might want it to be a little bit more frequent. But I'd say, for most people, on a semi-annual basis will be sufficient. If you're really scaling up, quarterly is probably better.
Does your firm do asset protection, sort of as well?
Not at the moment. Not at the moment.
Tax.
It's tax and accounting. We are looking into it. We may bring an attorney into our firm.
The disconnect between lawyers and CPAs is really.
Yeah.
I mean, I've heard things. I'm like, I don't know which way to go.
Yeah, no, we're exploring bringing an attorney into the firm to handle the entity structuring, and because CPAs can't really set up entities necessarily. It's more in the realm of an attorney. So we're exploring that, and that might be to come. Maybe in 2020. But yeah.
All right, guys, any further questions? Anything you want to ask?
I got a question. Are you familiar with Section 280A at all? I think it's on the individual side.
Section 288, you talking about home offices?
Yeah.
Yeah.
So I came across a strategy. It sounded a little aggressive, and I don't know if people were actually implementing it. But
Yeah.
essentially, a business can rent a home office, pay the rent to the individual, and the individual doesn't have to claim it as income because it's excludable under 280A.
So you're saying a business, like, for instance, like,
LLC.
So are you saying by a related party?
Yeah.
So by the same person. Yeah, I don't know what the purpose of doing that would be.
You would get the deduction under the LLC, but the individual will exclude it in their income and individual income.
Yeah, I heard of that before. There's something called the self-rental rules, which basically the self-rental rules. Just trying to recall exactly how they work off the top of my head. The self-rental rules. I'll give you a second. I'm just trying to think of how they work.
You gotta know everything off the top.
Yeah, no, I just the self-rental rules is something we don't deal with too often. The self-rental rules, I could get back to you on that.
I've heard of it.
Yeah.
I've heard it a couple times, but I haven't heard of anybody implementing it or
Yeah,
using that strategy because it seems a little bit aggressive.
Yeah, I was.
Aren't home offices like a kind of a red flag already?
So home office, you get the home office deduction for having a home office that you use exclusively as your place of business, and it's only a red. The red flag of the home office is a myth. The reason why it's a myth is because Schedule C is the part. If you're a sole proprietor or you're a consultant, you don't have an S corp or something like that. Schedule C is where you report your income as a sole proprietor. Schedule C is the most audited financial, the audited part of the tax return. And most people who have Schedule C also have a home. A lot of people who have home office also have Schedule C. So because of that, they think that the home office is the trigger. The home office isn't necessarily a trigger. It's usually it's the fact that you have the Schedule C. So by taking the home office deduction, no. But what you're saying sounds like it could be relatively aggressive.
Yeah, because the LLC will write it off as a rent expense, not necessarily a home office expense, because they're paying the individual rent to rent out the home for a meeting.
Yeah.
And the individual is excluding it from their income under 280A.
Yeah, I would have to take another look into it.
It explicitly says that in the code, but like I cannot find anything that supports that.
Yeah,
guidance.
yeah. I mean, if it says it right in the code, then you could do it.
Yeah, I know. I haven't heard any real estate investors
Yeah,
that take advantage
I mean, I don't.
besides what I'm hearing from like folks in-
I see why someone would maybe want to do it because you're receiving, because
writing off expenses,
yeah.
but not claiming income.
The business is giving the income to the individual. It's not getting taxed on that income and is writing it off. Yeah,
Redistribution.
yeah. I mean,
Yeah. The only thing I could say is you have to charge fair market rates for the rental of, let's say, your kitchen or something like that. But it's almost as if the real estate business is renting.
Tax an asset protection person too. Same thing.
Yeah.
I was
It's
told
almost
about
as if
that.
you're renting this
I've done
space,
it.
but instead of this space being the Marriott, it's at your house, right? You would still need to charge some type of rental fee to the
Yeah.
LLC that's performing the service, and then that rental income is excludable.
yeah, no,
to the individual.
that might be possible. I'm gonna take another look into that one as well. It's not something I've not come across. That I've came across people trying to do similar things with like other properties they own, renting out other properties to themselves essentially, and usually that just causes issues with the self-rental rules, which I can't recall right this second. So.
Wouldn't that be like a meeting though? You're holding a meeting.
Yeah, it's
as
almost
opposed
like
to renting
so
on
the
regular.
strategy is you would hold some type of quarterly meeting with your partner
Right.
at your house,
That's a little different.
and that cash would
Yeah.
That would be more legitimate, I would think, than the actual ongoing basis. Even though if you do have a home office, it would be.
Yeah, no, I mean it could be very well legitimate, but the home office, like, so the 280A code that I see the most often that we refer to is the home office is used as your primary place of business where you meet with your patients or clients, and you get a deduction for that. Now your employer can also pay for the use of your home office as well. So maybe that's what you're referring to. But when it's the related party, and what I mean by that is when you own both entities. Like, so for instance, say you owned an entity and you employed me, right? You could rent out part of my home as an office, so I could work in it. You get that deduction. But when it's a related party, that's when the self-rental rules come into play. And again, I
think it just needs to be at an arm's length transaction, but I don't know.
Yeah.
I was told
I'm
to
not
take
gonna be the
quotes
first one.
from
Yeah.
area hotels and what the fair market value for a room for the half day,
Yeah.
and like for a breakfast or lunch meeting kind of thing. And
Yeah.
that amount is charged to yourself, like reimbursed to yourself. Instead of paying a hotel, you could pay it to yourself and get reimbursed for like $500 for
Yeah,
a half
yeah,
day or a day.
Yeah, I'm gonna look into that one. It's not something I've came across. And I've dealt with a lot of people who would try to
Well, like,
will try to do something like that.
Those binders, it always says
Yeah, well, most of the time,
Needs a your house.
you know, most of the time what I see people doing is what we see people doing is just they take the home office deduction, which is just a deduction on their tax return. They're not charging themselves back rent for it.
It's just a standard number for a home office.
So the home office is a safe harbor deduction of $5 per square foot, or there's the actual expense method where you would take the percentage of your home, and it's the percentage of your home dedicated to your home office. So let's just say for easy math, your home was 1,000 square feet, and your home office is 100 square feet. That's 10%. You're gonna be able to deduct 10% of all your home related expenses. But that's what we've seen. I mean, I don't know really the practical uses of that, to bill yourself $500 for half the day. I mean, I see why someone would use it, but
Well, if you have quarterly meetings, now you're $2,000 a year.
yeah, I know. I'm gonna look into this.
Yeah.
Quarterly meeting.
This is something I'm gonna look into now a little bit deeper, because now you guys.
I'll send you the regs. It's clear.
Yeah.
I just never heard
I mean,
of
look,
anybody doing it before.
Yeah, I mean, if it's in the regs,
Yeah.
if it's in the regulations, you could do it. It's just not. It's not something I'm too familiar with.
Yeah. You've heard of that too.
Yeah, adding that to my list of stuff to look up. So.
I have a question for you.
Yeah.
Is there any, because I always hear deductions for people who own homes, and I know obviously that got changed. Everybody here is probably pissed that owns a home. What about people that rent the place? Is there any sort of tax benefits for that or no?
No, not really.
That's what I thought.
You can take the home office deduction still if you rent your property. So I mean that's about it. Yeah, but no, there's no real tax benefits to renting a unit to live in.
And just because the home office deduction is on your individual return or on the LLC?
So it's on the individual return. Now, if you have, so maybe this is what you're talking. Maybe this is what you might be saying. If you have an S corporation, you have to reimburse yourself for the home office deduction. And so maybe that's what you're referring. Maybe that's what you're referring. But this is referring to. But that's just the nuances of the S corporation. That's not. It's not some lucrative tax strategy. It's just the compliance issues you have to deal with when you have an S corporation. Yeah. So. But yeah.
All right, perfect. I think we'll cut it there, a little bit shorter, less people. Thank you guys for coming. We have the room until 10, so feel free to say hello to us. Make sure you meet everybody. If you have any personal questions for Tom, make sure you meet him. And thanks again. Yeah. Everybody make sure you thank Tom for coming. Decide to spend his day, his resources, so thank you, Tom.